to part 2 of chapter 2's video. So I'm gonna go through this really quickly. I should have done this before you guys got first hit play. Sorry, it's going. Let me turn off the slideshow for a minute, get to where I want. So what I'm going to start talking about now is the flip side of after we've worked on increase or decrease, which is what you guys have mastered at this point. We're going to start moving into the world of accounting speak, which is using the words debits and credits. All we're going to do in this part is we're going to replace the words increase or decrease. There's that darn red ink again. With debits and credits. Right, and whether we attach the word increase is going to depend on the account category. And you'll see that as we go through it. So this is called a T account. A T account is something that we use. You'll notice it looks like a T. We use it in accounting to help us track journal entries that we've been making. And so we usually have an account name up on the top. In this case, we've got assets, which is the category. That's fine. And what we have to learn is whether we attach the word debit or credit to an increase based on the account category. Okay, so you're going to end up referring back to this slide a lot because, for example, if my cash increases, you guys have gotten good at learning, okay, if somebody gives me cash, I need to increase my cash. I'm going to attach the word debit if my cash is increased. Okay, however, let's just say, again, I borrowed money from Bank of America and I've increased my note payable, which is a liability. And in that case, I'm going to attach the word credit, right? So I'm still increasing, but because it's a liability, I'm attaching the word credit. Versus when I increase an asset, I attach the word debit. So you'll end up referring back to both of these grids often because they're a good cheat sheet on how it works. Now, you're probably thinking to yourself, I cannot remember this slide. There's no way I can memorize this. I'm not going to ask you to. Instead, what a lot of people use, let me see if I've got a little thing for it. They use this acronym, DELOR. DEALOR. What does DELOR mean? I don't know. But hopefully you can remember the word. But what it does is it helps you by remembering you can draw a T account. Right, here we've got our T. And then you can write out DEA on the left, LOR on the right. From there you can remember the D stands for dividends, E expenses, A assets, L liabilities, O owner's equity or stockholders' equity, R revenue. So you might be like, well, that's great. I can remember the word DELOR. I can remember the DEAs on the left, the LORs on the right, but how does that help me? Well, it can help you because then all you have to remember is that if it's on the left, we attach debit when it's an increase, and we attach credit when it's a decrease. If it's on the right, we attach debit when it's a decrease and credit when it's an increase. Okay, so this probably feels like a lot of steps right now. You're going to be amazed at how good you get at this. All right, so let's talk about actually going through and recording a journal entry. A journal entry is an official term we use for the format of how we record transactions. A journal is where we record them, right? So think of it like a diary, right? Your diary is your journal, right? Does anybody actually keep diaries anymore? Probably not. Whereas every time you write in it, that's a diary entry or a journal entry, okay? In accounting world, we like to be super retentive. It's just the nature of my people. We love to be super specific. Couple things you always have to remember. When you're making a journal entry, and this will be true in Connect, right? Debits always go first, right? We just put them first. We do. Don't ask me why. That's just our thing, right? If we were writing it out on a piece of paper, we would indent the credit, okay? Right, and then we always, what you're going to find as you go through this is the magic of it is debits will always equal credits. Let's just say you're doing an exam and you're doing a journal entry and you notice that you have a debit for $10 and another debit of $10. I want you to stop and say, wait a minute, debits don't equal credits because I have $20 of debits and $0 of credits. That should key off into your mind, one of these is wrong, right? Because if I made a journal entry for $10 of debits and $10 of credits, heck, I might have the journal entry wrong, but at least I know debits equal credits, and I'm more likely than not getting it correct. All right, let's do an example. And this is the same thing we did in the first lecture of Eagle Golf Academy. So again, somebody gives us cash and we issue common stock. In the past, we said that cash increased, right? And we said common stock increased. All right, we know cash is an asset. We know common stock is part of owner's equity or stockholder's equity. If I go back, to this, okay, if I want to increase an asset, I need a debit. If I want to increase owner's equity, I need a credit. So now let me go back to my journal entry. I said cash is an asset, so I know I want to debit it, $25,000, right, cash. And I know common stock is a piece of owner's equity. Oops, I should indent it, like I just said. And I know to increase it, I need a credit. Quick check-in, my debits equal my credits. So, huzzah, I know my entry's in good shape. Okay. Now, there's a bunch of problems we're going to work in class around this to get you guys super comfortable with it. So I'm not going to work them in this lecture, but instead I want to go to the other concept that we're going to cover in class. And it's kind of a funny little thing, and it's called posting. Now, in the real world, what posting means is that, let me just start this slideshow again from current. I'm sure I'm back on red, so let's switch to blue. What posting means is I'm taking all those journal entries, remember all those individual journal entries I made in my journal, and I'm updating the general ledger. The general ledger is one location and it has every single account balance, right? Because journal entries do nothing more than change the account balance. I still have to do math to figure out what the balance is. And so posting, today computers do it. Today computers take all those journal entries and they calculate the updated account balance. We're going to show it in a very rudimentary way that's just going to help us as we go through the process. All right, so for example, I'm going to use T accounts here. See these T's? That represents my general ledger. And I have a T account for cash, a T account for equipment. This assumes that I've already posted the first two entries that the company had made. Now it's time to post the third. So the journal entry was already made, a debit to equipment, a credit to cash. To post it simply means I'm going to take the debit to equipment and I'm going to put it on the left. Debits always go on the left, credits always go on the right. Let me say that again. Debits always go on the left, and credits always go on the right. Right? That doesn't indicate, that's not indicative of the increase, decrease. That has to do with the account type. But when I'm posting, debits on the left, credits on the right. Stand up, sit down, fight, fight, fight. Maybe I'll even try to find a video for Friday class on this. All right, debits on the left, credits on the right. So I've posted this first line, the debit of $24,000 to equipment, and now I'll post the credit of $24,000 to cash. Now what the general ledger will do for us then is sum it up. Okay, the balance in equipment's $24,000, the balance in cash is $11,000, right? Because it had two other postings. So it had a debit of $25,000, debit of $10,000, credit of $24,000. We sum that up and we end up with a debit balance of $11,000. right? If we'd overdrawn our checking account, we could have ended up with a credit balance, but we didn't, right? So what you'll be doing in Connect is going through and doing a lot of these postings. You're going to be deciding what their ending balances are for the accounts. Now, stop for a second. Why do you think I care what these ending balances are after my journal entries? Remember, the whole purpose is we've been trying to take economic events, right, and turn them eventually into the balance sheet and the income statement. So what I had to do in between is I had to do journal entries, right, to record the events. Now I'm going to post them so that I have balances, and I can use those balances to create my balance sheet and income statement. Accounts receivable, will it go on the balance sheet or income statement? If you said balance sheet, you're right. Service revenue, balance sheet or income statement. If you said income statement, you're right. So having that sum or that total for those accounts is our key step to be able to start to build those financial statements. Right? And we just keep posting to all the accounts. And then I've got something, and this is, again, in the nice world of computers, the computer does this all nice and neat. We use these T accounts just to show us, right? So see all the T's. I've got a T for cash, balance of $6,900, a T for accounts receivable, balance of $2,000, etc. So I've got all my balances, and I can start to build those financial statements. So let me get through here so you can see what it looks like. Okay, so this is what it would look like after I have summed up all those balances, and now I've started to put what's called a trial balance together. This is not my final financial statement. It's an interim step, right? I'm probably spelling interim wrong. Interim? I don't know. Does it have a U? Just go with me on this, right? It's an interim step because we're going to do one more thing in Chapter 3 before we finalize those financial statements. But this is an interim step to say, let me list every account I have, whether it's balance sheet or income statement. I'm going to say that again. I'm going to list every account I have, whether it's balance sheet or income statement. If that balance from the T accounts, right, because remember we had things that looked like this in the T accounts. See, I've got that balance of $6,900 right there. I'm going to put the balance of $6,900 on this trial balance, and I'm going to do that for every account. If I've done my job right, you'll see that they equal. Hooray, right? If not, I got to go back and I got to say, wait, did I bring over something incorrectly and put it in the wrong column? Did I total up my balances incorrectly? Or did I actually do a journal entry incorrectly? So I got to tell you, there's not as much of a sweet, sweet feeling as when this balances. All right, so that's where we're going to stop this lecture. And we'll work on this on Friday if you're in fall 2020 semester.